All right, folks. So the market's trying to get up there, right? You see this. We open strong, and then we start to give it away right away. So here's the thing. It's up on earnings. They're not the big names, but some consequential names. Ironically, we talk a lot on this show about earnings estimates, and they were starting to go up in the summertime here. Citi put out this piece today saying if you take into account, though, the revisions and some of the early releases, we're down at the low points right now with respect to earnings, which is may not be a bad thing. You know, we like clearing those slow hurdles. So let's just give a situational awareness because a lot of moving parts of what's happening right now. Coming into today, we know the big trends, equities lower, bonds lower, the dollar sideways. I love to see the dollar come down some. Gold taking off, and Bitcoin out of nowhere, really taking off. So let's go over this because there's so many things to work out and to digest here. Remember, the S&P 500, if it's going to get to that, if it's going to have a big year, a breakout year, we got to get it through 4,600, and that's just 2 months left in the year. So I want to bring in Bianco Research President Jim Bianco. Jim, I want to begin with earnings, and to me, it seems like it's going to be key. I've got a chart up here going back to 2020 of the composition of returns for this market. So you go back to 2020, and it was all about multiple growth, right? So 23% of the move was multiple growth. Then the year after that, 2021, 34% of the move was earnings. A big year for earnings. This year, it's been 5% earnings, 5% multiple growth. I mean, obviously, there's not a lot of room left for multiple growth, particularly when it's in those key names. So to me, this is it. The earnings have to really come out, some big numbers and some big guidance. What are your thoughts?
Well, I agree with you. The key is going to be that you're going to have to see some big earnings numbers. The economy is also set to report on Thursday a very good GDP number. That should presage that, you know, the third quarter earnings numbers should be good. And the reason you need them to be good is because of what you talked about, the multiple contraction. What leads a multiple contraction? Higher interest rates. And if we're going to have to, if the stock market has a hurdle of higher interest rates, it needs to outperform on earnings and other things to beat that hurdle. What do I mean by that hurdle? Dr. Jeremy Siegel just put out a new edition of his great book, Stocks for the Long Run. In it, he says the long-term return of the stock market is around 8%. Well, if you could get 5.5% in a money market fund, and you can, then all of a sudden you're going to get half to 2/3 of the stock market's gain with no risk. The stock market can't just give you 8% and so earnings. It has to do better than that if it wants to continue to track money and go higher.
By the way, and since you brought that up, I'm also going to point to this tiny sliver, which is dividends, because to your point, when people are getting this kind of yield, they no longer need to rely on these dividend-producing stocks. Hence, one of the reasons utilities have taken it on the chin when usually they're the ones who do well in this environment. Let's talk about the S&P, the 200-day moving average. We're right there. We went a little bit below it. We're a little bit above it. Let's call it 4,200 and generalize it. Some resistance at 4,400. We break out at 4,600. This, to me, is the moment of truth, right? I mean, but what happens if we start to break down under there? Because I think we could trigger some big selling as well.
I agree. You know, the 200-day moving average is kind of a benchmark that technicians like to use to say, is the trend of the stock market up or down? Is it above or below its 200-day moving average? We're right on it. If we start moving below it and the market starts going down, then we're going to go back to that, you know, argument that we've had all year, we being the collective of the market, that 7 stocks have held up the whole stock market. You take out the Magnificent 7, the rest of the market's down. It's in a downtrend. It can't rally. This is supposed to be year 2 of a bull market, and it's not going up. Maybe I ought to get out of it. And then you look over at your 5.5% money market fund, and you go, maybe I ought to go hide over there. So yes, this is important that the stock market shows some resiliency at this level, that it can hold this 200-day moving average and not get into the definition of a downtrend.
All right, and then there's Bitcoin, which has been quiet almost all year long. This is absolutely amazing, this move that it's made. It was just kind of moseying along, and it's taken off. And I saw where you tweeted this spike here. I guess technicians are calling it a God candle. Does that mean $1 million Bitcoin is right around the corner?
Yeah, I guess so. I never heard of a God candle. I think that means God's adopting Bitcoin, which would be really bullish if that happened. But I do think that there's 2 fundamental stories behind this move. One, the Depository Trust Corporation, DTTC, has now gotten a filing from BlackRock to be the custodian for their spot Bitcoin ETF. That doesn't mean it was approved, but it sounds like BlackRock's getting ready for it to be approved. And then Tom Emmer is starting to emerge as possibly the next Speaker of the House. He's about as pro-crypto as you can find, and he might be the next Speaker of the House. So combine those two things together, and the technicians talking about the God candle, and yeah, you've had a spectacular 24 hours in cryptocurrencies led by Bitcoin.
And what's really interesting about it is that all of the Bitcoin fans that that you normally see around this time, they haven't been around. I think they were even caught flat-footed. So this sort of is, or feels more organic, if you will. Hey Jim, thanks a lot. Always appreciate starting the show with you. All right, folks, don't look now, but the